Welcome to the close. 10 minutes of trading left in today's session. Joining us to help break down today's action, we've got trader Dan Brady of Entropy Capital standing by live at the NYSE ARCA Options in San Francisco. Our featured guest is Michael Yoshikami, Chief Investment Strategist at YCMNet Advisors. And Michael, it's the question du jour. Got to talk to me about your thoughts on today's jobs release.
I think the job release shows that the economy still has struggles. We still have some headwinds here. Obviously, the numbers were a little bit worse than expected. It's going to be a stop and start. You're going to see the economy getting better, but I don't think we should get too excited. The economy has problems that it has to work itself through. And let's remember, many of these job numbers are very, very impacted by what's happening in the stimulus program. What happens when that stimulus goes away? So I think it's a wake-up call that things are not well. They're better, but they're not well.
Well, let me ask you, you know, I was doing a tease for you earlier, pointing out that Barron's picked you as one of their top 100 financial advisors. So to put that to the test here, in this, what really I'm guessing is going to be a difficult environment to invest in as the stimulus gets pulled away, as quantitative easing, as they start to wind that stuff down, what do you do as an investor?
Well, first of all, I think you capitalize on fixed income that I think is priced for destruction, and I don't think destruction is coming. So you buy reasonable grade corporate fixed income, even some of the municipal debt out there. Secondly, you buy assets that have strong cash flow. We have a junk rally happening right now. We have many assets that are highly leveraged, that have rallied, and I think in the end, cash flow is going to matter. So companies that have consistent earning streams, companies in tailwind industries, yes, places like energy, even technology, and of course, globalization plays, the Caterpillars, the infrastructure of the world. I think you need to be more selective. Some call it a stock picker's market. I would say you just need to be very, very selective how you invest. And don't forget, Matt, commodities. I think commodities are still going to have tailwinds here. Even if the dollar strengthens, I think commodities are still going to be inhaled globally, and I think that's a good place to be.
Dan Brady, I want to bring you into this. We've had an interesting day here. You know, some selling right at the open, then we bounced back. What were you guys talking about on the floor today?
Well, in regards to the obligatory unemployment question, I think there are two interesting things. One is that at 10.2%, we're now almost at the stress case that was in the stress test scenario, like the exaggerated stress case for next year. All consensus have it that the unemployment rate is going to continue to go up, some as much as 11%. The second element of this is that it hasn't peaked yet, but it's going to take a long time for it actually starts to go down. We're talking about maybe perhaps another 12 months before we get below 10% again. I don't think the average person outside of Wall Street is prepared for this.
Well, why didn't we see more selling, though? We were all kind of shocked here, you know, after that number. And futures, you know, what they were indicating right after the report and then how the market played out through the day, why didn't we see more selling?
Well, the perverse case is that, you know, with the unemployment rate here and with the Fed's statement from earlier in the week, rates are going to essentially be zero until the unemployment rate starts going down. So now we're looking at a zero interest rate environment for perhaps a year. And that's going to push people into risk assets where they can get capital appreciation or income. And I think you're going to continue to see money going into the stock market, particularly, you know, high beta plays.
You know what, let me actually ask Michael quickly. I once took a class about the architecture of Detroit, which pointed out that all the office buildings were connected with bridges or underground tunnels that could get to your parking garage, that kept kind of the rich working people away from the dangerous parts of Detroit. Do we live in that kind of economy now where Wall Street and the people who are the haves aren't quite as affected by the have-nots? I mean, does it not bother the market that unemployment climbs to 10% because the market doesn't really need that part of the economy?
Well, I don't think there's class warfare happening right now. What I do think is happening is that there's a tremendous amount of money sitting on the sidelines, and we have a panic happening right now, Matt. I think that the panic really is, geez, the market was at 6,500. It's now at 10,000. Where was I? I was sitting in cash. So when you start to see dips, when you start to see negative news, I think you're going to start to see cash go back into the market. I do think that both are connected. But again, remember, even though we're saying 10% unemployment, let's say it another way. We have 90% employment. And of that 90% employment, people are coming out of bunkers, which is why you're starting to see consumer spending come back. So I don't think it's a class warfare, but I do think that it's overstated a little bit. I think 10% unemployment is really a problem. If you're part of that 10%, it's a gigantic problem. But there still is 90% working. And if you just look around and talk to people around you, most people's consumer spending has been impacted, but people are starting to spend again.
If you take the comprehensive employment rate, it's much, much higher, as you know, hitting a record today. What was it? I think 17.5% or something. I mean, so
that's correct.
There's a lot more people who would rather have full-time jobs. They don't have it. So it's a lot more severe than just looking at the unemployment rate today.
I think that's absolutely true. I think that you have the underemployed and you have people looking are in jobs that they don't even want to be in. So you're absolutely correct. I'm not in any way suggesting, and I don't want to imply this, I'm not in any way suggesting that 10% or 17% is a great thing. What I'm saying is the stock market is very much like an adolescent child, and it's pricing in 20 or 25%. Perhaps that's what it was pricing in if you think about where the markets were 2,000 points ago.
Gotcha.
So I think the stock market is looking forward when employment starts to drop, whether it's 10% or 17%, for it to go to 7% or 14%.
You know, so Michael, Sheila kind of talking about the relationships between stocks and jobs. I mean, can stocks continue to rally without job creation?
The answer is no. And I'll tell you what I think the concern is really for stocks at this point. I still am rather bullish in terms of the next 6 or 12 months for stocks. However, the rally we've seen right now is very much an anticipatory rally. And the concern I'm starting to see is really, Carol, that valuations are starting to get ahead of where maybe stocks should be anticipating the economy is going. The reality is consumers are going to spend less if unemployment continues to rise or at least stays high. And in our view, it's going to stay high for a significant period of time, maybe 7-8% for years. And we have commercial real estate problems and residential real estate still having problems.
Right.
It then becomes a valuation argument. And where the market is trading right now, it's getting pretty close to a pretty optimistic fair valuation. And I think that's why investors need to be very selective in how they invest, and don't forget assets like fixed income and commodities.
Dan, you see signs that the rally is stalling?
Well, I think it's going to stall for the short term in respect to we just finished earnings season, and now we're getting into the holiday season. So I think, if nothing else, it's going to be less volatility over the next couple of months, just because there aren't any explicit catalysts out there to really move the market around.
I want to quickly ask you about momentum here. We only have about 30 seconds left with Dan. Do you see a turnaround? Because this week we had all up days, and it looked like the momentum had turned back down.
Well, I think that, you know, a couple of people got scared out of the market there the last early couple of days this week when we had those sharp sell-offs. But now, if you look at the VIX level, we're back down to 24. So I think we're back into that comfort zone where you're going to see people comfortably entering the market.
Let me talk, though, a little bit about the trade here, because I'm looking at the S&P was up 2 weeks, down 2 weeks, up 2 weeks, down 2 weeks. Here we are up a week. Just kind of expressing some of the uncertainty still kind of in the marketplace again as kind of people get back to the fundamentals, start focusing again on the economy.
Yeah, and I think, again, it's a matter of being selective. I mean, we really had a rising tide at this point. That's why the S&P has done so well. But out of the S&P 500, there's probably 100 or a couple hundred names you might want to own. There's probably 200 or 300 names that have rallied beyond the fundamentals. So that's why, again, I think it's very, very important that you're selective. It's just not going to be a no-brainer market the way it has been the last 4 or 5 months.
Let me ask a little bit about your thoughts on gold, because I know you think that people are going to still be eating up commodities left and right. Is gold one of them, though, since it has obviously very little industrial use? I mean, even if the dollar strengthens, you said, is that not the case with the gold?
Well, you know, we have gold in our portfolios, and we're still underweight gold relative to what our target weightings are. We think that gold still is going to show some strength, not so much necessarily, obviously, on the industrial side, but I think it's a fair trade. In a way, gold, if you go naked gold, I don't know if I'd be buying gold at 1,100. I know that my friend Jim Rogers was talking about after the IMF actually sells their gold position, that might be time to buy. IMF sold a lot of their gold to India, and gold actually went up. But I think gold should be part of a hedge strategy. Naked, it's hard to say, but as a hedge strategy, there's still lots of danger in the market. And as you know, when the market drops, gold tends to do very well.
So let me ask you, now that we've covered fully the commodities picture here, about individual stocks. What do you like right now? You often pick winners here, which is why we continue to bring you back. So what do you have for us?
Well, first of all, General Electric. I noticed that Bernstein today came out and talked about GE Capital's position might be not as tenuous as some are suggesting. We think General Electric is doing a lot of things right. They're divesting a lot of their businesses. They're getting much more focused, and I think they're a global infrastructure play. Another stock that I think is very interesting is Activision. Activision has DJ Hero as well as Call of Duty, and there's pretty negative expectations on this stock because it's basically a consumer stock. It's possible we might have a surprise this Christmas. And I think that Activision actually is a play that might benefit from a return of the consumer, even if we do have those high unemployment rates.
You've got to have Call of Duty 5, I guess, under the Christmas tree. Let me ask quickly about GE here. I know it's very trendy for companies to divest of businesses that aren't considered their core, but NBC has obviously better margins than any other GE business. It's never become clear to me why they would want out of something with such high margins.
Because the margins aren't that high when things aren't going well, and NBC is really in last place at this point, and it's not a core part of what they own. It's no different than when Anheuser-Busch sold the theme park division. It's just not a core of what they do. They're remaking that company, and this has been Jeff Immelt's focus from the very start, remake it to a focused, higher margin, not necessarily media companies that are focused on infrastructure, global growth. If you look at all the advertising, all the commercials you see, they're based on power, energy, wind, international expansion. That's where he's focusing.
All right. Michael, thank you so much for joining us. Michael Yoshikami there from YCMNet Advisors. Don't want to get that wrong.